Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Euro dollar. A bullish thrusting pattern yesterday after the previous session's second bearish black crow. Prices saw an initial drop down through the November 2020 low at 116.02 down to the 2019 high at 115.70 before a reactionary bounce back up through both of those, as well as the bright red breached lower bull channel line of the mid 25 based bright red shallow bull channel. That's currently, that bull channel is 116.24 to 121.02. This pattern had been the main showrunner for this market since the middle of last year. However, the market stalled soon after, not wishing, it seems, to test the next resistances, and that's of the gold long moving average overhead, currently at 116.73, and the mauve medium moving average, currently 116.97, though we did close just over the bright red lower bull channel line. This tentative close back up does not ring well with a proper repair to the breached bright red bull channel. Additionally, this is now a third consecutive close below the late January, very early March descending wedge pattern. We've already reached the primary target, though we still have a much harder to reach, possibly too hard to reach, secondary target X1 down in the 1356 zone. Looking further below, there is some close congestion between 114.82 to 114.95 formed from the January and February 2022 highs, followed by the June 2020 high at 114.22. Now, so far today, a counter-reactionary move back down below the bright red lower bull channel line, November 2020 low, but not yet piercing the 2019 high. Cable, aka sterling against the US dollar. An indecisive spinning top pattern yesterday after that, actually, an indecisive spinning top yesterday that also hid a reactionary bullish harami in there. And this is after the previous session's second bearish black crow. The market opened within the late January to date descending wedge pattern, which is currently 133.40 to 134.64, but was supported in its efforts to move lower by the, supported, that's the wrong way, was helped in its efforts to move lower by the previously mentioned congestion, currently between 132.98 to 133.17. Made up from the purple neckline extension of the small April to May 2025 head and shoulders continuation pattern, which is at 133.17, along with the nearby bright green neckline, currently 132.98 for the August to October 2025 head and shoulders top, and the March 22 high, and also that's also at 132.98 for January this year. So altogether a significant new dynamic band. Pullback higher through the bright red lower trend line was capped, well, unsurprisingly, by the flatlining mauve medium moving average, currently at 133.96, with not far above it the 2024 high at 134.34, and the gold flatlining long moving average, currently 134.42. Looking further down, we have the combined August 24 high and 61.8% Fibonacci line on the June 16 to September 22 move at 132.65. Plus the 38.2% Fibonacci line, the June 16 to September 22 move at 132.46. So yeah, we've got both of those. Seemingly very close to together, though in truth, I think it is just ahead of better support from the bright pink neckline for the August to October 25 head and shoulders top, currently at 132.35, and that's where I concentrate my view. Below this, well, it is a fairly free zone down to the congestion between 131.33 to 131.44. Overall, this was yet another market pressing below the bright red lower trend line of the descending wedge pattern, and yet with no closes below it, and what is more, no consecutive closes below this bright red trend line, so not even one close, but none actually below it, well, the downside potentials and targets have still not been triggered, and I'm wondering about that. However, in the bigger picture, prices maintain their stance within the previously broken and now seemingly repaired very shallow dark blue bear channel, dating between early July and early August last year through to late January this year. And that's currently 129.71 to 135.98. So far today, another attempt lower, though through the bright red lower trend line, but getting caught once again, for now at least, within the next congestion band between 132.98 to 133.17, though admittedly at the lower end of it, and ending up right now just over the bright, or just around the bright red lower trend line once again. US dollar against the Japanese yen. A reactionary bearish below the stomach pattern yesterday after the previous session's second bullish white soldier. This is a blow for those bulls out there looking to trigger the recent idea of a mid-January today double bottom pattern. As though prices have breached the trigger level on their top side, they have not managed to close over it. Not once, as yet. In the bigger picture, we still remain within the previously breached but seemingly repaired bright red April to November 2025 bull channel. That's currently 151.84 to 158.66. Additionally, we have a newer and slightly steeper September and November 2025 to date bright green bull channel, currently 153.20 to 160.83. And I continue to ponder on if this will take over the bullish incentive in this market. Meanwhile, looking below, we have support a little distance below from the green short medium moving average, currently at 156.08. The mauve medium moving average, currently 155.50. And in between them, the June 1990 high at 155.78. Well, so far today, a dip down towards the green short medium moving average. But right now, the market seems reluctant to test this, and has instead pulled back up within yesterday's true range. It's looking a bit like a hammer pattern at the moment. US dollar against the CNH, the offshore Chinese yuan. A reactionary bearish engulfing pattern yesterday after the previous session's third and quite large bullish white soldier. The initial rise was capped by the combination of the interesting bright red trendline extension, currently at 693.44, of the May to August 2022 ascending triangle, along with the broken upper bear channel line. That's currently at 693.24. Of the shallower broken January based bear channel, and with increasingly important descending green short medium moving average, currently at 694.09, in close attendance. That's a little above. The decline and low close went back under the broken lower shallower bear channel line, currently at 689.63, as well as the May 23 low at 689.53, closing just under both. Now, looking further down, we have the significant 50% Fibonacci line of the February 22 to April 25 move at 686.60. Now, the recent action has elements of a bullish diving board pattern, with recent days being the pull-up after the dive. This is a significant bullish reversal pattern and would be the first bullish pattern of note for quite some time if it comes about. However, this diving board pattern is now compromised by yesterday's actions, as the last 2 days might leave us with a possible pipe top instead of a diving board pattern overall. Resolution on this, well, it's likely to emerge by this weekend. Now, so far today, a higher open over the May 23 and shallower lower bull channel line, but then a dip down towards a significant 50% Fibonacci line below, though not managing to make much way before pulling back higher, and for now around again the broken May 23 lower bull channel combination. US dollar against the Brazilian real. A complex series of simultaneous patterns yesterday. An immediate countering bearish dark cloud cover pattern, as well as a bearish opening black Marobozo, plus it could also be seen as a significant bearish belt hold pattern. This after the previous session's bullish opening long white Marobozo and second bullish white soldier. The open was slightly higher, but prices dropped down all the way to, of course, Where will they go to? The dark blue middle time, currently at 519.49 of the important dark blue mid-December 24 to mid-April 25 bearish shift pitch hawk, before prices bounced up to close just under the lesser Fibonacci line at 524.07. This long-running dark blue bearish shift pitch hawk is still the very excellent showrunner here for this market. But if yesterday's action does turn out to include a true bearish belt hold pattern, then there will be greater concerns on the downside for this, as this pattern tends to be one of the more reliable patterns in technical analysis. That's the belt hold pattern. US dollar against the Mexican peso. A reactionary bearish harami yesterday, if only just, after the previous session's fourth, much larger when compared to recent sessions, bullish white soldier. The market dropped down to test a number of recent resistances that had become supports and found that they have mainly held up. We've dropped down through the small congestion between 1756.95 to 1759.58, containing the combined August 2017 and July 24 lows at 1759.58, and pierced the green descending short medium moving average, currently 1752.56, but did not close below it. What was not pierced but ended up supporting the market were the upper time, currently at 1746.87 of the bright green April to November 25 bearish shift pitch fork, as well as the now breached upper channel line to the dark blue November 25 to early March bear channel, and that's currently at 1743.37. And that's the showrunner here since late last year. And finally, the July 2017 high at 1743.74. Now, we've got a number of patterns to consider here. The first is that the whole mid-January to end of February action is a double bottom, Adam and Eve type. This would have a primary target X in the 1790.80 zone area above, so not too far from this week's high. And a secondary harder to reach target X1 up in the 1805.95 zone area. These targets are still live and still doable. The second, we still have potential to look at the February action as a possible cup with handle pattern, still in the build. This is looking less likely now, but we will know within the next few days if this is going to happen or not. So far today, well, what looks like a possible bullish harami right now is once again the congestion below the green short medium moving average is halting attempts lower, though not exactly encouraging moves higher either.
Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.